Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Old lessons, new learners. This is what we are going to speak now. What happens when valuations become so juicy that investors don't want to sell, but promoters and large institutional shareholders are very comfortable selling? The retail investor and the system that represents the retail investor, which is the mutual fund and the organized investing industry, wants to invest more. But the promoters and large shareholders, venture capitalists, private equity investors, are more than happy to sell their own shares, or the company is willing to raise shares at the elevated valuations. So there are two different sets of people wanting to do exactly the opposite things. And when you have two sets of people more than willing to do the opposite things, they would naturally trade with each other and capital will change hands in exchange for assets. The velocity of capital changing hands increases significantly. This is not new to Indian capital markets. Whenever there's too much capital coming into the capital markets from retail investors and HNIs, then this exchange of capital happens at a very, very elevated pace. But history has taught us one thing: it never sustains. So, this exchange of capital for equity will happen until the flows sustain, and the flows will sustain until fear cracks the whip. But when this wave of transactions happen, what really takes place is that the valuations remain extremely elevated. I have seen this as a very young investor in 1994. When foreigners wanted to quickly come and get stakes in Indian companies, companies were more than happy to do GDRs at very elevated valuations. And the transactions happened pretty fast. Companies found it very easy to raise money. Sometimes promoters also sold. But remember that at those times, promoter shareholding was low. So the preferred option was to raise money in the companies. Today it's not so. We've come a long way since 1994. Promoter shareholding is reasonably high and promoters are more than happy to dilute. So money flows from the institutions, which is mutual funds and ultra HNIs and retail investors through the mutual funds into the pockets of the promoters and very large venture capital firms and private equity firms. So the mistake which happened in 1994 affected the foreign institutional investors, and they were the predominant set of investors who participated. Retail investors hardly participated in 1994. In fact, the HNI category was virtually non-existent at that time. So the damage was entirely at the hands of FIs. Where retail investors made a mistake around that time was participating very heavily in the Morgan Stanley IPO, but that's a different subject and I would not mix it with this video. Now cut to the present. Today we are seeing FIIs selling, venture capitalists and foreign firms selling, and Indian investors buying at elevated valuations. I am fairly certain that, like 1994, this will also lead to a very long price correction, because companies are not going to be able to justify these valuation and transaction valuations. So companies are going to struggle in their business performance to satisfy investors who come in at these valuations. And investors may need to stay for years to get the full benefit. Even 2-3 years is a very long time for most of these investors, because they are coming in based on the past performance and thinking the next year will be like last year. That's the construct of the money that is coming in. Next year should be like last year. If next year is not like last year, if next year is a disappointment, then this money will want to go out. So what will the managers do? They'll have to sell these assets. Now in 94, this happened gradually because FIIs waited for 3-4 years before they got out. They got out by 99. But now I don't expect the retail investors to show the same patience, because there's no history of him doing that. It's virtually impossible to think that retail investors who get in through mutual funds and the mutual fund invests in these overvalued companies will wait for more than a couple of years. It would be a miracle if they wait for 2 years itself. And what would happen when they want to get out is funds will start selling stocks and they will be forced to sell at any valuation. So look at it this way, and this was the old lesson which is being relearned now. When you buy at any valuation because you want liquidity. And when you sell at any valuation because you want the liquidity. So both ways, liquidity is misdirecting investor behavior. In 1994, it misdirected FIIs. Today, it is misdirecting retail investors. And that's not going to lead to a happy situation. It's going to lead us to a very troubled spot. Having said that, I think it's inevitable and we'll have to live with the times. But there was always a choice for many of us to avoid going into these spaces. The sad irony is, retail investors have directly taken ownership and gone into these spaces and invested large sums of money. In fact, many people have their investments only in the risky parts of the market. I worry for them, but there's little more that I could do for them. Thank you for watching this video.